Good evening, ladies and gentlemen. Welcome back to Stocks to Buy as we review why I'm only buying these 4 stocks, but we got a long ways to go before we get there because I'm going to roll back a little bit. We got to talk about the perplexing realities of the stock market because it's confusing as hell, isn't it? And so many of you have been pointing out some of these confusing factors, which I'm going to do some individual videos on because some of you are pointing out, some of these Canadian construction companies that are just blowing up for some reason. That'll be a video for another day. And congrats to be the first time catching this live stream. You could always watch it after as well. But let's get into it by first and foremost, just talking about the realities of the current market situation and how persistent it has truly been to the bulls that just continually bought. And we'll talk about the strategy that's been the strongest. I made a really kind of divisive video yesterday, just talking about even though I talk a lot about Canadian stocks, Canadian dividend stocks shouldn't be the orientation if you're looking for wealth accumulation and growth. I mean, it's great for income, but it's the smallest percentage of mine and my fiance's portfolio, as we'll discuss, and kind of the strategies that have worked for me so well over the last decade. But it's mind-blowing that NVIDIA alone accounted for more than, a third of the entire S&P 500 gains, which is nuts. I think NVIDIA is somewhat of a bubble here, but the reality is I never had the cojones to buy NVIDIA, but it's still this proponent of tech that has really propelled the S&P 500. And what's really interesting to me is if you go back, and even as perplexing as NVIDIA has been for me, I think during the pandemic era, this was probably one of the most fascinating times in the stock market for me personally, because it was the only real crash that I think so many of us new investors actually got to experience. And when you actually compare the market to GDP, which obviously I think GDP is somewhat of a realm, a real contributing factor to growth. And I think even over long periods of time, so long as GDP is going up, the stock market will inevitably catch up. I see so many clowns on the internet trying to always compare that the markets are overvalued versus GDP and versus this and versus that. But valuations don't mean anything. The markets are pure fugazi. I'm a clown on the internet, so are all day. We're going to talk about the reality of why none of that matters, bro. I love talking numbers, but they're such bullshit at the end of the day. I got a huge argument with somebody about valuations, and we'll kind of refine that. But keeping on this idea of just GDP, when you take a look at where we were sitting during the pandemic, it was the first time in my investing career that US GDP actually went negative. And it didn't actually go that bad into the negative, which is kind of crazy to consider. It barely dropped, but since basically over the last 25 years, the only last time that happened was during the 2008 financial crisis. There's only been 2 times in US history that GDP has ever really dropped. You know how staggering and insane this is? If you actually look at how historically impactful like 2008 was, and even the pandemic was, for how materially unimpactful they were to the total GDP at the time, it's kind of staggering, right? But if you take a look at the S&P 500 and look at the opportunities that came during these periods, I mean, you definitely look at the pandemic, right, which we gobbled up so many good companies down here that led to some of the best returns of my entire investing career. And even some of the speculative stocks like MindMed, Tesla. I mean, so many companies coming into this just did exceptionally well. And you take a look, even if you were able to buy and you had the cojones to pick up, you were up 135%. And then obviously this bull run that persisted and everyone was like, oh, it's great. And then interest rates kind of came shooting along, and interest rates put everybody into a bear sentiment that we're heading into an economic collapse because of inflation. That never happened, but the market dropped 25%, which if you, again, had the cojones to buy all the way down and maybe even were lucky enough to pick some shares up at the very bottom here, I mean, you saw a very insane 51% gain off those lows as well. And even if you were buying 5 years ago, you're up 84%. Again, bulls always win. Bears eventually get sent to slaughter. The market reality, unless some crazy world war, nuclear event, black swan, destructive thing that completely terrorizes the market happens, I think your best option here is to not get caught too much into the fear. And that's where I really want to talk about the kind of idea of valuation and my my investing career here that is now going on almost 10 years. I kind of looked at this today and my mind was blown that 10 years is almost past. As September of this year will be the official 10-year of me investing. And I want to just kind of resonate with you on my total return, because so many investors, I think, lack the understanding of, hey, like, I'm going to show you all the stocks I'm buying, but we're never going to talk about how much money I'm actually making. I mean, me, Kevin, Jeremy, I can't really find one legit YouTuber anymore in the finance space that will show the entirety of their returns. And I don't mean like, oh, the public account, oh, the one stock I bought, I made all the money on, but I don't talk about the losses, just the fact that I recaptured it by selling it at a tax loss harvest, bought the bottoms, and then show you the gains. we see so much of that nefariousness that goes on without like a lack of long-term, positioning and potential and understanding, right? So we'll get into this by first and taking a look at my longest running account. And there's so much history that goes into this. And I have such a, nostalgic time looking through this because it literally takes me back to the very first time I ever bought a stock back in September of 2014. I have not been investing for that long, folks. A decade is nothing. But I always told myself that if I could outperform the market for at least 5 to 10 years, then like I wouldn't shun myself away from. I actually do a much more conservative strategy today, but I said if I could outperform the market for 10 years, I'd keep trying to pick individual stocks and do whatever. I'm way more conservative than that. But again, we still have a sizable amount of individual positions these days between me and the fiance. Now, just taking a look here, what's most intriguing is the amount of times that this chart exploded and then flatlined. Because one of the first companies I ever bought, and I always like to resonate this with people, is that you zoom in right here. My account, and I can't click it, but it dropped almost 50%. Because I bought a company called Canopy Growth Corp. And I think it took from 2014 when I started buying that. I mean, legalization really didn't happen until 2018. And I already transferred all the money out of this account because I started getting a little bit of gain from Canopy right here, this little bump into 2017. But then there was some real gains that happened to my TFSA we'll see during this time, because this is when I transfer most of that over. But again, nothing really happened because I had no money in this account for a while. And then to come 2019, 2020, this was like MindMed, all these other companies that really kind of exploded the account. And then I pulled all my money out of this account for a real estate purchase. So there's a flat lining here. And then I bought a little bit of stock, or was this during the time that I sold here again, maybe to buy real estate? I don't know. I've been in and out of these accounts coming to 2023 and 2024, but we're still up in this account 300. There's no money in this account. There hasn't been for half a year, almost a year now by the looks of it. And we're up 328% still against the S&P 500 that's only up 163%. And the NASDAQ that's only up about 265%. So this has been one of the best performing accounts that I've had. There are some better ones, but we'll start. I mean, I can't even believe that I'd say there's some better ones, but here's the TFSA where I've been a lot more conservative. And this has probably been too conservative to my detriment, because if I was a little bit more aggressive, like I was in my other accounts, I just always had that fear that, this is a tax advantaged account. And if I lose money on a stock, I can never regain that contribution room. So I was always a little bit more cautious, a little more diversified, but still, to the likes of outperformance is astounding. So again, during 2017, 2018, you can see the first stock I transferred over here was Canopy Growth Corp. It was a good start, a risky start, but hey, legalization just hit in 2018, and man, did it ever explode, because we made like 50% returns. It looks like 60, 70% returns just within the first year. And then, I bought Apple and a lot of these tech companies, and everything did perpetually fine pretty much till the pandemic, where we saw quite a little bit of a dip there. Nothing too severe, but still pretty substantial. It took me back to the gain peaks that I had in 2017, but things rebounded obviously, and I stuck with the game, and we did exceptionally well. And then again, I purchased a piece of real estate here, so I pulled all this money out sometime during 2023, or maybe even just before, or no, January. Yeah, sometime mid-Jan to July of 2023, I emptied the account, and I only recently just started investing back into it, which is why it's not at all-time highs. Because obviously, if I kept the money in here, most of it was index fund based, and I mean, tech companies, Apple, whatever, it had done well. But now we're only just starting to get the recovery. However, this account's still up 177%. S&P's only up 118, and the Nasdaq's up 169. Very, very impressive. Now, on this side of it, this is pure luck. I mean, obviously, a lot of this is speculative in nature, but this account probably represents the best gain I've ever seen, and that was out of Tesla, obviously. I didn't capture as much as maybe a lot of people did, but it's still pretty proud of the 254% gain that I got out of this, because I think I made enough to buy at least a Tesla. I think we made $30,000 or $40,000 in gains off this account coming into 2020, which was absolutely insane. It seems like my best luck always started when I just opened these accounts. Man, oh man, I mean, just in 2020 alone, this thing went up 200%. Now we've been hovering a bit because all my money's been in SCHD. That hasn't really gone anywhere. Now I am starting to buy a bit more Tesla in here again. Nothing too crazy, but SCHD is the majority of the position. But even to this day, up 254%. The S&P's up 77%. The NASDAQ up 104%. This account has been, bananas, absolutely bananas. Now, I wish I was more ballsy and leveragey. I mean, everybody always wishes they could go back and put more in, but then the guy that blows up his account wish he didn't put as much in. So you're always playing this psychological conservative versus aggressive game. And again, like I said, I wish I was a millionaire. It took me 10 years to get to this point. And I'm not on an individual basis. I'm not. Me and my fiance combined will likely have a $1 million Canadian net worth, if that means anything, by the end of this year, probably. I mean, we're on the cusp of it, and I'll probably do a video once we achieve it. And I probably won't even know what happened because it's hard to calculate real estate value and all this other crap. But still, like, you know, I miss what Dave Ramsey said, and he made I can't remember the exact reference. Some of you might have seen the video where he talks about, like, there's no guarantee that this is going to work out and you're going to become a millionaire within. I always figured that it would take 10 to 15 years, but, you know, everyone's like, oh, you can do it in 10, but there's no guarantee. But hey, even if you land it with 300,000 or $500,000, are you really complaining? Because it's where I kind of feel like I fell into, because I'm probably 550, 600K, somewhere around, I don't really know. So somewhere within, you know, above the $500,000 mark, which is insane to be at my age. It puts me close to the upper 1 to 2% for Canadians of net worth. Not that I care. Like, I'm not here trying to stack and compete as much as I am just competing against myself in this game of, can you retire early, right? Anyways, just taking a look here, I really want to kind of talk about one more account, and then I want to get into the total portfolio and just kind of abbreviate to where I think we sit today, where the economy is kind of going in the future. And though I'm speculating heavily, I'm going to prove to you why everybody's a clown, what's worked, what continues to work, and why investing is likely very simple. Most of my gains came from very speculative stocks, but I think I could have done a lot better if I was just more persistent with a very specific class. My corporate account has like 100,000 sitting in it, and it's just kind of kept up with the performance of the S&P 500 because I only own the S&P in this account. I do own, I think, a few little small positions in some speculative stocks, some of those individual plays that are way smaller and materially not going to impact the portfolio unless they become lottery tickets, plus private placements and whatever other crap my corporation holds. But still, like, this account is pretty much irrelevant because I'm not really competing for performance here. But the total of the portfolio today, which I talked about yesterday in kind of an abrasive manner about, like, you can see why Canadian stocks are the smallest position in the entire portfolio. And I really feel like you get kind of confirmation biases between investors, whether they're Canadian investors, they tend to focus on Canadian stocks because of their uncomfortability buying US and trading currencies. And then you get value investors. Value investors orient around, you know, all these tools, and they want you to buy these tools and calculate value, and it should be trading at this fair value and that fair value, and which doesn't exist anymore. Finding cigarette butts, even Warren Buffett says, doesn't work. There's no reality to that anymore. Like, if you're buying companies that are suppressed, there's no guarantee they even come back anymore. I can show you companies trading at 1 to 2 PEs that they just don't go up. Look at the gold market. I mean, gold's exploded, and that value has barely hit so many gold companies out there, which is crazy, right? Because the value of money is just floating in specific companies, and you're trying to convince major shareholders. Again, just because company has good earnings doesn't always mean the market, the stock goes up either, right? It's kind of a weird, it's so weird to think of the market that way, because we always think that, you know, with dividends specifically, they end up hitting the market value and then you get paid out and whatever. But when it comes to earnings per share, it's just funny how through dilution and all these other mechanisms of the market that, like, sometimes stocks won't even go up on good earnings, which is fascinating to me. And when it comes to the Canadian economy specifically, it's just funny that, like, I have such a bullish sentiment around Canadian banks. Anything that in the Canadian economy has outperformed, and there's just not a lot of that. So if you're looking for income, it's great. But if you're looking for growth and income, outside of the financial sector, it's been very hard because tech has been very volatile here over the coming years. I mean, because there's so few tech companies that became very bubbly, they're some of the only companies that have yet to recover from the crash of tech. I mean, look at something like Shopify. It is nowhere near its highs. It kind of bothers me a little bit at how, you know, awkward and uncomfortable Canada's GDP has been. And I work with, like, literally, I have worked with probably 1,000 Canadian companies at this point, and I still talk to so many regularly, and I look at all the insanity and the bureaucracy behind development of commodities specifically. I mean, Canada should be one of the richest countries on the planet from commodities. I mean, we're so commodity rich, it's insane, yet we can't capitalize on it very well. And a lot of regulation and bullshit about ESG and all this stuff that just prevents mines from getting permitted is really hindered a lot of the growth that comes into Canada's, you know, growth vectors here. You look at the GDP, it's a good defining factor. If you compare GDP actually to some of the ETFs that just track the broader market, you'll see a lot of familiarity in the, you know, the volatility of these stocks, right? Which I find very interesting, because I always thought, like, GDP growth should almost be a 1-to-1 to basically immigration growth or like population growth. And I always found it interesting for the millions and millions of people that have been flooding into our country that GDP has just not expanded that much. Basically since the midst of 2013. I mean, we really haven't grown the insane levels that the US has seen within the same consistencies, which just shows you the value creation in these two countries. And for what a small country, the lack of that growth there's been. And a lot of that's probably related to real estate and some other stuff as well. But yeah, it's just kind of interesting. Whereas you look at a country like China, like arguably should be one of the greatest investment opportunities ever. I mean, this emerging country that pulled itself just out of a second world is basically a first world country at this point. It might as well be. I mean, yeah, it's communism, but I mean, this country, the growth and the company sizes and the technology advancements are pretty insane. I mean, you really can't look at China through the view of media. I mean, you go to these countries and you should really experience them for yourselves. I think I really want to go to China. You know, just even since we got back from our trip, it's kind of crazy when you go to places like Turkey and you look at some of these countries that have no homeless. And it's just interesting how these different governments have approached these problems, and they do a better job at certain, economic, problems better than even the Western world has done. And it's really interesting, right? Because there's like pros and cons to these countries. I'm not a big fan of communism. I've seen my fair share of very, politically divisive. And I talk to people from Russia. I know people with families in Russia, and they said you do not want to be a young man in Russia right now. Like, I mean, these countries are not places you particularly want to invest, but the growth you cannot argue, right? China's growth is just, it's historic. I mean, from the 1999 all the way till now, you can see why people like Charlie Munger took interest, but it's hard to get accurate reporting. There's so much variance to a country that makes up like 1/3 the world's population. So, I mean, they're even saying their GDP is not accurate. And for those of you that don't understand exactly what GDP is, it's just gross domestic product sales. It's literally just calculating the total value creation and the sales, like interacting between people. When you report your taxes, how much I bought, spent, whatever, companies are reporting sales, income, like all of that just kind of reflects on GDP. It's literally just the products that move between me and you, and the services that move between me and you, and the value that's kind of getting created year over year in a dollar figure, right? And you look at the the Chinese composite here, and it has not moved anywhere near close to the same growth metrics that the US has moved in. I mean, even from 1999, it's only up 149%, which just goes to show you that GDP isn't a one-to-one reflection to growth. I mean, Alibaba, arguably, if you believe in the growth of China, this is probably the cheapest company on the planet right now for the growth that it has offered. And again, it's just a lot of people, they've been buying it all the way down, and they have not seen any returns. Which just goes to show you that like valuation doesn't always matter. Maybe it does matter in the long run, but the fact is valuation truly mattered enough that, even the likes of Charlie Munger got caught up in this, and he said it was his biggest mistake ever. How can one of the greatest investors of all time say that Alibaba was one of his greatest mistakes of all time? And it just goes to show you that valuation doesn't always matter. And I really want to kind of hit that home, because if you want to see real returns in your portfolio, you really have to pay attention to this. But if we take a look at total GDP, obviously Asia is massive. But for the size of North America, I think it's the third largest population, America. I mean, it pumps out such a huge percentage of global GDP next to Europe, South America. Africa's coming up a lot right now. It's fun looking at all these different countries and their GDP growth. I honestly think if you want to make real money off some of these developing countries, that you need to go there and start a business rather than trying to invest. If you're investing, you got to be a little bit more careful. I think if you're more hands-on, you might have a more strategic, perception of the business realities there, and government, political, all that stuff. You really need to pay attention to a lot of it. But somebody brought up that says, hey, Kyle, can you help me figure out the best way to buy US stocks since I earn CAD? There are so many options, and I want to avoid high exchange and commission fees. I currently use Wealthsimple. Any advice? So this is an interesting thing we discuss a lot, because Wealthsimple, although they offer commission-free trading, I think unless you have a certain amount of money in there, they don't allow you to do currency conversion for free. I pay the insane $10 commission from the big banks here in Canada, and I love it because I can do commission free trading. So I can buy everything in euros if I want, everything in USD, and they don't charge you a fee. I'm sure they're slipping it in there somewhere and hiding it in the exchange rate, but they say they don't charge a fee. And I love it because I can trade in foreign currency and make money in foreign currency, which I find just utterly fascinating. It always blows my mind that Canada actually allows you to open up a tax-free savings account, buy foreign stocks, make money off those foreign companies in their own given countries, take all the gains and the returns those companies make, and spend them freely, tax-free here, without paying that government any money and without paying your own government any money. That always just blows my effing mind. I'm like, I could never get around that reality. And people always like to shit on Canada so much, but they do offer some pretty absurd things. This topic, Basically always starts as a harsh debate. I am in my mid 30s and I go pretty heavy in Canadian dividend paying stocks along with American ones. I think it is due to my personality. I get excited seeing a steady growth, and even small dividend payouts make me happy, especially when they dip. I personally really like VYM, and it's becoming one of my largest biggest holdings. I am wanting to change this up a bit and divest from the Canadian to the, well, basically from Canada to an extent. I like some of the points you made with the current landscape. I really don't think Canada in general is positioned for growth, which is sad because we really could be such a prosperous nation, have everything we need, but it is basically being squandered at the incomprehensible level. Now, like I said, there's so much debate to this stuff, and I really don't want to get into it. I just like the place of diversity and going to where the logical growth is. And we're going to talk about the individual positioning and why I focus on these 4 specific stocks. Right now, again, you could be so indifferent to this because everybody's so different. This is just after scaling, getting to the position that I'm in, what I like to do to make my life a lot easier than trying to play the individual stock game. Because again, a lot of people underperform, and there is only one way to win at the individual stock game, as far as I can see it now, in the path of least resistance, in my opinion. But obviously, I still buy the Vanguard Canadian Dividend ETF because I think this gives me the best exposure to not only the highest growth oriented stocks, but the highest dividend growth and income oriented stocks, because I don't like tech companies here. Unfortunately, I just don't like Shopify, these few companies that have controlled and honestly have lacked the performance of even the banks, because, well, again, over the long run have excelled, but they're very, very volatile. Whereas you get Royal Bank, Toronto Dominion Bank, we've talked about these companies. Canada isn't just an oil oriented country, so you're not just oil exposed, even though it says you're energy exposed. Canada Natural Resources and Enbridge are some of the largest natural gas players and pipelines to North America. Like, these are very fundamental businesses, and I really like this for income, and it will eventually be a very large proponent to my income strategy. It's just, I don't want income today. So it seems kind of foolish to buy a lower performing over the long run ETF. So I do focus a lot on the Schwab Dividend Equity ETF. Now, I look at both these ETFs as recovery plays for when they start cutting interest rates, because a lot of the companies they hold within these 2 ETFs are largely affected by interest rates. We know that, right? But the thing is like, we don't know how long that strategy is going to take to pan out. I mean, interest recovery is going to bake into the S&P. It's going to bake into a lot of the Schwab stocks, the VDY stocks. It's just a matter of when, and that could be another 1, 2, 3 years from now. And we don't know how low they go. So you got to be very patient if you're focused on recovery plays, but that's why I'm still buying them. That's why I still think, yeah, they've lackluster performance, but you got to recognize that somewhere over the long run, their businesses are going to continue to grow. They've made them much stronger by laying people off, as every company has done, and offering further efficiencies to the business. They just need more capital, which they can get through lines of credit when the equity is cheaper, and they don't have to pay as much interest on the loans they already have. And you look at these companies, there's a lot of growth companies still in here. Like, obviously you have defensive like Lockheed Martin, Coca-Cola, obviously Pfizer, Chevron, Verizon especially will benefit from interest rate cuts, BlackRock, Pepsi. So many of these companies will benefit dramatically from a lower interest rate environment, which leads me into the strategy that is the tried and true strategy that led to most of the gains that I've had in my portfolio, which largely come from growth companies. And a lot of people's concerns around the S&P 500 is that it's so tech-centric. But my argument is the only reason you should be buying the S&P 500 is because it is so tech-centric. I like the Qs. I like the S&P. Now, I'm not as aggressive as buying the QQQ ETF. That's because my fiance and I own a lot of individual tech companies. I mean, we do own a fairly large position that adds up with the positioning in the S&P when it comes to Apple and Microsoft and Meta, outside of Google, because I sold it, but my fiance still holds a little bit of individual Google stock. But I mean, I love this because these companies are going to become monopolies. There's an inevitability upon us where we're going to run into a society where the government's either going to intervene or they're not. If they do not intervene, these companies are going to basically take over the entire world. They already are. I mean, once robotics and AI, which is again a bubble, I'm not arguing that AI is happening tomorrow, but this is like crypto and all this stuff. The technology is so advanced, but how many people are actually utilizing AI? I use it in my job. I see the impact it has on my job. It's not good enough to replace me yet, but it sure as hell made my job, the complicated part, pretty much so anybody can do it, which I find interesting. And YouTubers out there and TikTokers, I'm sure you've seen a lot of AI content that's coming, right? But it's not here yet. So when you look at all this money being spent on big companies into NVIDIA, that's the only real money that's being made in AI right now. But we'll talk about what my real AI play is in a moment. But I think people should focus on this. This is reality, man. Yeah, are they expensive? 100%. They're expensive because in 10 years, and if you're 20 years old, you have so long for these values to bake in. But the only trade that has existed since 2010 has been tech. If you just bought tech companies and cost average into the S&P, you would have outperformed beyond imagination. And that's what I pretty much did. That's what my fiance is doing. That is what we are pretty much doing now. And it just seems so dumb that people always argue that with me. And it's like, you have been wrong for what is going on 15 years. Since the bottom of the financial crisis, we are in a technological revolution, guys. It hasn't stopped yet. Margin expansion. I mean, we're talking about a company like NVIDIA that's making 80% margin. You know how crazy that is? NVIDIA right now, they have to justify the current valuation, they have to double up their net income once. I don't know if they can do it or how long it takes if other companies start scaling up their chips. But the fact of the reality is today, NVIDIA is making 80% margins and is the third largest company pretty much in the world that's publicly traded. You know how crazy that is? It's kind of a mind-boggling thing when you really look at the numbers and how that even exists. Because you go back to the early, like even in the 90s, most companies didn't make 80% fucking margin. You're like the only people that made 80% margin in the 80s and 90s was Pablo Escobar. And when I always reference drug dealers to these companies, because that is the reality. Like, I mean, you can't make those kind of margins no one ever thought, like, that was always software. Now we have physical hardware companies that are making those kind of margins, right? So, you know, when I'm looking at my four primary investments, and again, I own crypto, I own individual stocks and a lot of small caps and stuff. Again, I talk about those companies. I don't like to project them as fruitfully as I do the rest of the things that I'm buying, because again, I look at them as speculations, and you should too. I don't look at small caps as businesses that are like cash flowing today. Like they have some speculation into the future, and if they work out, the returns are insane. And when you look at things that have 1,000x potential, you don't throw, like some people might, maybe if you're like a GameStop guy there and you like gambling and you're speculating, yeah, throw the whole farm, bet the whole farm and the wife on it. Sure. I'm not that guy though. So I try not to project the lottery tickets as much as I do the things that I have, you know, a more idea of a future, more idea of cash flow today, more idea of like what's happening. And I want to round this out to that conversation of like, when you're buying individual stocks, you're looking for one of two things, right? You're either looking what has worked predictably in the past that will likely continue in the future, which is big tech. Look at the S&P top 10 companies, pick the top three. Are you going to lose money? Maybe. I have a hard time believing it because you've been wrong for 15 years if you bet against it. So Apple, Microsoft, you can't really go wrong with that strategy, right? Like make that, like if you're younger, 10, 20, 30. And again, I'm not financial advising this. It's just how I've come to see it. But you make it a decent chunk of your portfolio, and then you cost average. You can even do it with the Qs, the S&P, and then look for some diversity elsewhere globally. It's good to have some global diversification, right? But still, when it comes to individual stocks, like I can't trust value because value doesn't exist. Apple's skyrocketing right now. If you look at the revenue, do you think Apple deserves to go up? Why is Apple going up? If revenue is the only thing, if earnings and revenue are the only thing that matters, just, I mean, look at this, right? This is why it always blows my mind. I hate arguing with value investors because they're just so dumb. They think this is the end defining factor to return. I mean, there's been no revenue growth for Apple since basically the beginning of 2022, coming out of 2021. It has been a while. Their net income hasn't really done anything either. It hasn't done anything. Why is Apple stock skyrocketing? Because people are speculating on AI, and they think there's going to be a huge cycle in the future of iPhone, MacBooks, Apple, you know, iPad upgrading, maybe even the watch. So they speculate that that's some value that's going to eventually materialize into earnings. So let's price it in now. That's how you get a bubble, right? Because there's no guarantee that's going to happen. But if you can foresee the future and something you understand, that is where you're going to make the most money in unimaginable amounts in your life. I did that with Canopy Growth Corp. Those insane initial returns I got was because I had one thesis, not value, not anything. My thesis was so stupid, so dumb. And that's how it always happens too. It's always something so stupid and simple. But my thesis really just boiled down to, in 4 years, they're going to legalize marijuana. Was I wrong? No, because we knew they were going to do it because he got elected. As soon as he got elected, we knew that was the plan. It was like, was that before he got elected? I was somewhere between there. It's like, let's just buy the largest MJ company. and it worked. It worked brilliantly. So what I'm looking at now is primarily focusing my funds into one stock. I think I understand. Now, I could be completely wrong, could be horribly wrong, which is why I'm not advising you to do it, because everyone likes to argue about it. But still, Tesla, these divisive companies, and that's usually where you make your best return on the most divisive companies sometimes. Right now, I don't understand NVIDIA, but I feel like I understand Tesla well enough that I really wanted to get back into it in a material way. So I got like almost 100 shares. I really want to get more than 100 shares, but I don't want to like get beyond 10% of my portfolio. I'm at 8% right now. So I'll just cost average into it because I don't want to get too crazy in case something catastrophic happens. And this is not something that everyone's going to be able to stomach. It's just a matter that the stock has definitely collapsed well below, I think I sold most of it out somewhere back here. I'm probably buying my shares back at a similar price to where I sold them out at. But the company's done a lot since then, because when I sold out of the company, they were nowhere where they were today. And obviously, it's still a very expensive company. And I don't want to talk much about all the divisive bullshit that people like to go on about. Oh, auto sales. Like, I don't expect them. Like, they might reach all-time high auto sales this year. They were the number one selling vehicle last year, but right now their China sales are picking up. I don't know. I honestly don't know how well the auto business is going to do. For me personally, I think EVs are the future. A lot of people don't. There's a lot of debate around this. That's not what I'm trying to debate here. I don't really know what happens with auto, but what I'm very certain of right now is that self-driving in 10 years, I'm very confident that it is going to be highly unlikely that you will buy a car that doesn't have some form of self-driving software in it. I think it is going to be absolutely insane if people are 10 years from now buying cars that don't have self-driving. And that doesn't matter if it's EV, hybrid, whatever the fuck. It's just the fact of safety. And eventually, I mean, right now, auto accidents have been going up, auto deaths. I think right now we passed 40,000 in the US, which I think in 2022 or 2021, it was somewhere down in like the 30s, like the low 30s. And they're blaming people on their cell phones. There's drugs. There's all kinds of stuff. I think there's going to be a time in the future where we're going to joke about, drinking and driving. You remember the days you used to get pulled over and go to jail for drinking and driving and lose your license? I don't think that's going to be a reality in the future. I think that's how we're going to be old and reminiscing about the past. That's why I said Google was one of my number one investments, because I thought self-driving there's only two companies that are worth buying for self-driving. And I think they are going to be one of the largest industries globally. I think they're going to be worth trillions. And it was either going to be Google or Tesla. Now, Google, I love it. I just, as mentioned, I don't like the competition they have. And I would own Google any day of the week if it wasn't for the fact that, again, I own it through the S&P 500. So again, I'm not saying I don't own it. I just don't own it on an individual level because I just don't trust their search, because search makes up 50% of their income and it's dropping. It is materially losing users. I mean, there's no way around that. I think the future is a lot harder for them than it used to be. And it's going to take a long time for YouTube and self-driving and all these new bets to catch up to making up more income than their Google search makes. And again, I could be wrong. I just don't want to speculate on it. I'm much more comfortable speculating on Tesla's future because they have so much growth in the auto industry still. They have so much growth in so many vectors that I just feel a lot more confident. Even though autos make up the majority of their sales, again, I think EVs are the future still. Higher interest rates have crushed the stock, and I'm taking advantage of it. It is going to be somewhat of a recovery play, right? But like I said, when it comes to self-driving, I am so obsessed with this. I don't think people appreciate how much my idea of watching YouTube right now is watching people drive self-driving cars. I watch so many YouTubers. I'm subscribed to like several of these guys, and I watch every upload. I watch the good. I watch the bad. I want to know what's terrible about it, what's good about it. And it is so jaw-dropping to me where it exists today. Is it perfect right now? Not at 100%. There's still issues with it, but it is still fucking mind-blowing that this shit exists to the level it does. You can go get a Waymo right now. Self-driving is being implemented in cities today. Tesla, for the vast majority of it, could probably do most of the driving for you. I know two people personally that I know that no longer drive their car. They told me that from the time they get up in the morning to the time they get to work and the time they get home, Tesla's doing all of it with zero intervention. Now, obviously, again, there are some, if you look at videos like this, which we're not going to watch right now, but this guy does a great job showing where it screws up. I don't know if it's just his Tesla or if it's like bugs in the system or what the deal is. Like I said, it's not perfect, but it is so fucking good that people are forgetting that this is happening right now, and I fucking want to be a part of it. And forget the cherry on top of the cakes with Tesla. I mean, we're talking about power walls and batteries and insurance and the infrastructure behind like electric vehicles as it is. I mean, what is it? Exxon partnered with them, Ford, everyone's partnering with Tesla's infrastructure systems. This company has so much over the next decade that they have moats that are just undisruptible. There's no one competing in self-driving. This is a $1 trillion thing that's about to happen in front of our eyes. It just seems so easy to me, which is why I'll load up on Tesla stock right now. I could be wrong. Could be wrong. I've been in Bird for almost a year. Honestly, I think it's still too early. I'm just reading through. Any suggestions to 26-year-old looking to buy real estate? Let's do some Q&As because I could beat around Tesla all day, but you guys are pointing out some very fascinating things when it comes to some of the Canadian stuff. But yeah, I mean, that's what you have to get, right? You have to find conviction in these individual companies, things that you think you understand, and you can kind of, fight against the grain on. And a lot of you guys have been pointing out some stuff. Maybe we'll run through the books on Bird real quick just to see what's going on. But let me read through some of your Q&As, and then we'll just kind of round back to some of these companies that I have not looked at that I'll probably do some individual videos on you. Tesla and Amazon are my biggest positions. I think even Amazon has some form of self-driving they've been working on. The problem is Tesla's got all the data, and they're finally proving that it works. I told myself I wouldn't buy Tesla until self-driving was actually generating revenue. But I realized every fucking idiot out there keeps saying Tesla's just a car company. And by the time self-driving is generating revenue, the stock is going to probably be so substantially higher that they're going to complain it's too expensive. That is what always happens. It's what happened with Canopy Growth Corp. Any real growth company that has something so dramatically pivotal, like you're always too late, right? And I feel like finally Tesla's down enough that the opportunity is persisting again. What program do you see cumulative growth of your stocks? What program do you use? That is just my banks. I'm just using Scotiabank, RBC, all the banks. They show you your growth, your total returns with dividends and growth. I don't know what you're using. I hope your platform shows you your total returns because, like I said, I believe total returns matter a lot. I am a dividend investor as much as I am a growth investor. And I truly believe one is not better than the other. Both should be, even in my parents' retirement, I told people this, like my parents in their retirement, they are not 100% dividends. They put money in the S&P and they're already up 20% on that position. And they can sell that out whenever they want to go on a trip or do something. There's nothing wrong with taking capital gains off the table. It's great. I told my parents, get enough cash flow to support your basic needs. And then from there, focus your investments on things that are going to provide the highest return. It doesn't have to be speculative. It could just be, again, an S&P 500 ETF, but don't purely focus on income because then you miss these moments of absurdity when you make all this money. I've seen the video of a guy wearing a suit on a roller coaster and he gets hit by a bird. He looks like you. Unfortunately, it wasn't me. I wish it was. I'd be a meme. I could live off that, sell it as an NFT maybe. First time catching. Yeah, okay, so let's get into a few of these. What Canadian banks allow fee exchange trade? What does this allow? I'm presuming you're saying free exchange trades. You mean you don't have to do to the Norbit's Gambit. Everyone talks about Norbit Gambit. I don't really understand. Like if you just look it up, like let me show you real quickly here. I'm going to leave these stocks up that you showed me because I don't want them to go away. But let me just show you real quick that, for example, Royal Bank exchange rate fee for clients. I don't know what people are talking about. Debit and credit, there are transactions. Consider these compromised markup around 2.5% on the top of the cost purchased. Does RBC most that's credit cards? Do banks charge exchange rates? Percentage such as 1 to 3% on the amount taken from that's an ATM. 1 sec, exchange rate. Let me just do USD to CAD on Royal Bank fee. Should do a question mark. How much does RBC charge for a rate? Around 2.5% for travelers that purchase RBC credit cards. I don't want credit cards. I just want to know the exchange rate. How much the bank? I'm going to have to look this up, but I promise you they don't charge you a fee because I already looked into my bank specifically and I talked to my bank about it. If you are basically a client of the bank and you're exchanging money, they don't charge you an exchange rate. Again, I think they're lying. They probably take like point something percent on top of it, but I've looked it up and they're not lying. I've done it for a 1-to-1. And I showed somebody in my chat group. I took a screenshot of it and then I took a screenshot of what Google said the exchange rate was. And it wasn't even off. It was almost dead on, which was surprising. What are your thoughts on Dollarama? I am purely US right now outside of, actually Dollarama has been a weird exception. I used to own it. I'm sad I sold it. It was truly a recession-proof company. Really defined recession-proof. Any suggestion to a 26-year-old looking to buy real estate investments in a year or so and looking to invest or park money until then? Personally, I think right now is the best time to buy real estate. If you were to ever buy real estate, man, depending on where you live, I know it's hard, but by the time they start cutting interest rates, it's going to get very competitive again. I mean, that was one of the reasons that we decided to buy real estate was because we had such a large deposit and we could handle the high interest rates, but nobody else can right now. So prices have actually come down a little bit on certain homes. But honestly, you got to be careful, because any money that you're looking to buy real estate, if you're looking to spend money within 3 years, I wouldn't put it in the market. The markets are just too volatile over a short period of time, that if it's 1 to 3 years, I would put it in high interest savings, put it in some cashable GICs or locked up 1 to 3 year GICs. Because you just got to be real careful if you have real estate money. That's why I pulled my money out of the market pretty early, because you don't know. There's no idea of where it goes in the next 3 years. So you got to be super careful. How much do you need to live passively? Not a whole lot, to be honest. If you own a property, I mean, I think I told you guys our total cost of living, if we paid our mortgage off, is like $25,000, 30,000 a year. I mean, if I get, let's say you get $500,000 in the bank, which we pretty much do, and you can make 10% a year on it. There's no 4% rule. Don't listen to that bullshit either. I hate when people are, oh, you live off 3%. No, realistically, if you make a 10% return a year and you pull 10% out, and the market goes up 10% next year and you pull 10% out, I mean, you're going to be combating inflation, sure, but that 10% is a lot of money. And I mean, can you not, like, you're not even going to probably spend that much. I mean, if we get a 10% return on $500,000, that's $50,000. We don't need that much. So, I mean, if we can make 5% on $500,000 and we have a paid for mortgage, our expenses are met. Like, we don't have any more expenses. And so long as dividend increases keep going up and the market keeps going up, we're fine. I mean, materially, it does not take that much, I think, to passively retire. It just depends on your cost of living. I am cheap. I'm frugal. My cost of living is not that high. But I'll keep working. It's not like I'm going to retire early. I just want to make sure that I have just that right amount of FU money, that I don't have to like rely on my job. And then I can just kind of float around on what interests me the most. Waste management banks are the only CAD stocks I'd buy. Very good point. They've crushed it this year. Absolutely crushed it. Questrade charges about 2% for USD. I mean, yeah, that's the thing, right? But they offer cheaper commission trading, right? So I think at Questrade, it's either free commission trading or they charge you like $5 or something. They're cheaper than the banks. So let's just talk about this one company. I'll just run a quick math on it, because you've been talking about it here. And I'm also very fascinated because I love seeing companies in Canada that look like this. This is kind of fucking astounding, really. I mean, the company has done nothing since 2011, and out of nowhere, for some reason, it's blowing up. And the price to earnings multiple is not that high. So let's try and figure out what's causing this growth, because construction companies, I thought, were getting absolutely devastated. I might just look the company up. I'm just going to open up Yahoo, because I don't trust Yahoo. It's always better to just go to their filings. So let's just take a quick look here. Yeah, always better to look at the actual filings, because Yahoo screws up so much data sometimes. So we'll just kind of dive into the financials and just take a quick look. I don't know what this company does. There's so much more you got to do for research, but apparently they're doing $3 billion in revenue, $3.5 billion in backlog. Holy shit. I heard that might be one of the reasons the stock's up a lot. 24 million in EBITDA. Margins aren't crazy. 24 million for $3 billion income. That's not so good. Let's just take a look at the statistics, and then we'll pull up their actual financials. But if we just take a look here, I want statistics first. Let's see what their margins are. Their margins are garbage, 2.5%. Return on equity is pretty good, 25%. But man, their margins are just absolutely terrible. 31% held by institutions. Payout ratio is nothing. Their dividends perfectly safe. I just don't know why their margins are so trashy, unless they're doing a lot of write-downs. Let's just take a look at the balance sheet real quick. This company's got 1.4 billion in assets. I'm presuming that's billions. Yeah, 1.4 billion in assets. Total liabilities about 1.1. So their asset to leverage is terrible. Why is this company doing so well? I mean, the backlog. I mean, they're not like the best balance sheet on the planet. Let me go back here. Let's take a look. Just sorry, I don't know if I was sharing Yahoo. Hopefully I was, but let me just take a look at their Q1. Can I look at their financial statement for Q1? Let's just take a quick peek here, shall we? Can you guys see that? Yeah, I mean, this company does not have the best balance sheet. I mean, you can see it here, right? Assets 1.4 billion. Oh, it actually looks like their assets, they're almost 1.1 billion in liabilities. So they have about 300 billion in underlying, or no, am I right? Unaudited 1,000 million. No, actually, they don't even have $1 billion in assets. They've only got about 300 million in underlying assets. That's not crazy. Construction revenue, 688 million. Construction revenue is growing, but their gross profit is absolute garbage. I do not like companies that don't have a lot of gross profit. So, I mean, yeah, I mean, this isn't even write-downs. This is literally their gross profit. Unless I can, are they going to show me depreciation cost here? Let's see if we can find it real quick. Why is this company skyrocketing so much? Are they going to show me year-over-year revenue? I didn't even look. Yeah, their year-over-year is not crazy. Maybe it's just backlog, and because they're trying to construct so much. I imagine they have some government funding or something. There's got to be some reason that this company is exploding. Maybe backlog increasing and government incentives or something. Amortization. Yeah, their amortization, is that how much they're writing down in amortization? What is this? Is it still in the thousands? No, that's not huge. They're not amortizing that much. It's like $1 million. Yeah, they're only amortizing a very small amount here, as far as I can tell. Yeah, I mean, yeah, the more I look at this, the more I'm not that appealed. Are they diluting? What's their shares look like? I see shares in here anywhere. Let me go back to Yahoo. We'll just see if this company's diluting. That's not fun either. Common stock. Yeah, they're also diluting a little bit. I mean, from 2020? Is that 2020? 2020, not huge dilution. I mean, they went from 108 to 115 million or billion shares, whatever it is, thousand, million, billion shares. I think a billion shares. Yeah, I mean, they've had some pretty good annual revenue growth, but it doesn't really appeal me too much. I'm not sure what the interest is. Do you guys know? Because I sure as hell don't. Yeah, I really like the waste kind of companies. They're a little bit better with their margins. I mean, I don't know if you guys seen like Waste Connections or Waste Management, but look at Waste Connections because it's a Canadian company. It's got a lot of U.S. exposure. Maybe I'll show you guys this last one and I'll get out of your hair. Because the waste companies, I mean, they're conglomerates, they're monopolies. There's nobody really competing with them. I always said I was going to buy these and I never got around to it. I kind of regret it because, I mean, even the year-to-date return is 16. Like, they're outperforming the markets. Their dividends are super safe. I mean, we'll just take a look quickly at their statistics here. Because again, like it's really easy to just get an idea of margin. Like, margin to me matters a lot to some extent. Like, let's just see, where's margin here? Did I lose it? Yeah, profit margins on this one. I mean, look at this, like 9.7% profit margin. Their operating margin is like 18%. I mean, this company is doing very well. I like to see like tech-like operating margins where you're getting like 30%. That's where you're getting like Apple and stuff. But for a company like this, their expenses might be a bit higher. There's probably more amortization costs than there was with that construction company because, this company's got a lot of trucks and stuff to write down. It's huge waste facilities and stuff they're depreciating. So that might be eating out of the profit margin a bit. But still, I mean, these numbers are great, right? You take a look here, 89% held by institutions, removes a lot of the volatility, payout ratio is 35%. These companies are truly recession-proof, very stable. There's, I think, if you look up an ETF, what I would suggest if you're bored, take some time and look up ETFs like the BMO Low Volatility ETF. This ETF is fascinating because these are kind of stocks that like I'd be more comfortable owning on an individual basis because these ETFs look for companies that might not have the highest return, but they have the most stable return. And I think for somebody even in retirement, I would highly recommend taking a look at these because they're fascinating. I don't like the high fees there that are associated with them. I mean, this one's got a 0.35% management. It's not the worst, but it's higher than I'd like it to be because it eats through a huge percentage of that dividend. But still, I mean, you look at the holdings in here and they're very fascinating. You got Metro and Loblaws, Hydro One, Waste Connection, Empire, Thomas Reuters, Fortis is in here. I mean, these companies are astounding. So, I mean, even if you're looking for individual stocks and you want income that has growth associated to it and you're not like just tech focused, maybe you're more in retirement, these are the kind of companies that I would more lean into because they're very recession proof, or even just buying this ETF. I mean, this is not the worst ETF to buy. It's probably one of the better ones I've come by. It's just the management fee it's not like exuberantly high, but it is high for my liking. Usually my peak is like 0.2, but I'd probably make the exception because this ETF, I really like this ETF a lot. But I saw Stella Jones, super simple company, Waste Connections. Yeah. Anyways, guys, I do appreciate you all stopping in this evening. Don't be a clown. Avoid us clowns. Do the responsible thing. Look for what's logical. Don't just listen to everybody on friggin' YouTube and Blossom Social and all these apps and these investors that just, again, take the broad view, man. Watch your PPC Ians of the world. Watch your Meet Kevins and your financial educations and your everything monies. Listen to everybody. Take the broad perspective. You'll realize what's been that has truly worked, because there's one thing that has worked, and I don't know why people avoid it. It's tech companies. It's worked. It's always worked. It's like it's worked for 15 years. It's probably going to work for another 10 years. Like, don't fight an uphill battle that's already been fought, folks. Stay cool. Stay awesome. And as always, I'll see you in the revolution. Peace.